Hello, Branka. Thank you for agreeing to join me for one new video in our series of podcasts that we started in the FinTech project. And without further discussion, I would go straight to our topic today. And I would kindly ask you to identify, to present us what are the most significant changes that we together have witnessed in the payment industry in the last, let's say, 1 year.
Yeah, thanks a lot, Vasile. First of all, thanks a lot for having me. I mean, it's a great pleasure to discuss a bit the topics and sort of the research focus of our team. So to go to your question, I mean, I would start by maybe stating the obvious. So innovation and the introduction of new technologies is really nothing new. So it has existed practically as long as the finance industry itself. But what we are now witnessing is that we are entering properly a new phase of digital age, where this combination of things, so new telecommunication, big data, cryptography, machine learning, all of these things together now have the potential to fundamentally change how the finance industry works in a much more faster and much more disruptive way than ever before. And like you posed your question, so I mean, we have absolutely seen this fundamental change in the payment industry, and we have witnessed this. And well, not necessarily within the last 2 years, but for sure within the last 10 years, we have witnessed unprecedented changes in the payment industry. So we have seen the introduction of new currencies, right, new business models, new forms of transactions. And among all of this, what I can identify as one of the most significant change has definitely been the emergence of fintech. So these companies that actually combine financial services with modern innovative technologies. And now within this broader concept of fintech, my work and some of the use cases that we have had under our FinTech Horizon 2020 project really focus on fintech credit. And this is broadly defined to include all credit activities that are facilitated by online platforms and at the same time are not operated by commercial banks. Now, why I have found this topic quite interesting is because it is really the case that these advances in IT that we have witnessed have enabled fintech providers and online markets to actually offer an alternative to traditional financial intermediaries, particularly in the context of the consumer and the commercial credit space. We have really seen that fintech credit has offered many opportunities on both sides of this spectrum, so both lenders and investors. And to be quite honest, I mean, it is, even though this topic is quite interesting, it is absolutely the case that fintech credit actually still makes up a quite small fraction of overall credit. But why is it interesting is because it is growing quite rapidly and it has the potential to actually become dominant in certain market segments. So we have absolutely seen this. We have examples from various countries where close to half of the unsecured personal lending is actually issued by fintechs. And of course, on the commercial side, and thinking a bit the European perspective, the health and the strength of the SME sector really represents a key priority for Europe. And yet what we are seeing is that business development is often hindered by the inability of these businesses to actually access adequate levels of funding. And over the recent years, this is exactly what we have seen, that alternative finance and these fintech credit providers have actually developed as a viable funding medium for SMEs. So to answer your question very simply, I really do think that the emergence of fintech in general and the emergence of fintech credit providers in particular do represent one of the most significant developments that we have seen within the finance industry within the last decade.
Thank you, Branka. And to connect with what you said of this big opportunity and potential created by the emergence of these fintechs, what would you say are the main benefits and risks that are associated with the emergence of these peer-to-peer lending platforms and maybe other fintech credit providers?
Yeah, so to be completely honest, having in mind how young this industry is, it is really too early for us to properly evaluate the complete impact that this would have Also the impact that it would have on the financial stability and much. And I think that this is even further made more complicated because of the differences in the business models of these P2P platforms and the different legislations in different countries, which in turn really do not allow us a lot of room to actually generalize our conclusions as to the impact that they will have. But nonetheless, I mean, with those constraints in mind, we are able to actually identify certain benefits and risks that are also drawn from the growing empirical work that has been going on this topic. So in terms of the impact on users, what I can say is that in principle, the use of new digital technologies and alternative data sources, which P2P platforms sort of promise, can in effect create a lot of benefits for the end users. And this can be sort of reflected in greater convenience, lower transactional costs, and I think most importantly, financial inclusion, so increasing access to credit. And talking from the academic perspective of this, so we have absolutely seen some micro evidence of the benefits that I have just now mentioned across specific markets and different platforms. So to name a few, so there have been quite a bit of studies about sort of the fintech credit market in the United States, and certain studies have found that fintech lenders in the US actually improves borrowers' convenience because they're able to process mortgages significantly faster than other lenders. And I think that the more important topic here is actually this topic of financial inclusion, and this has been researched quite a bit in the literature now. And we also have seen some evidence that fintech platforms can actually lead to wider access to credit. And to give you an example, probably Chinese super apps are a prime example for this and how the right technology can really sort of fill in the credit gap that exists in those markets. And I'm sure that you're also familiar with this, but these e-commerce giants, so Alibaba's MyBank and BBank, they have really been considered within the literature to fundamentally change the finance service landscape in China, because they're actually utilizing advanced technology and alternative data for the purpose of making this process more efficient. So providing a lot more access to credit to both sort of less wealthy consumers that would have lower scorings, as well as companies that would have lower credit score as well. So there have been quite a bit of evidence of the sort of the link between fintech credit and greater financial inclusion. Now, of course, with benefits, there always comes risk, and particularly for the P2P lending system and the lending business model, this really carries inherent risks. To give you one, so I think that one of the main sort of disadvantages for the P2P business model is that the source of funding of these platforms represents really a key weakness, because it is strongly reliant on the investors retaining confidence in the platform, so to maintain levels of lending. And just to give you an idea of how this actually, we have seen evidence of this weakness, it's sort of the situation with the P2P market within the Corona-19, with the COVID pandemic that is now unfolding. So what we notice is that as these national lockdowns actually started to go on, investors rushed to withdraw their funds from P2P lending platforms. And this sort of was an equivalent of a run on the P2P lending sector. And in response, the platform sort of had quite a varied response. So some platforms actually froze withdrawals, leaving investors really unable to access their cash, and others sort of sought other ways to protect themselves. So there was a platform that actually just temporarily cut interest rates or increased the fees. So the 2020 sort of COVID pandemic was really a test for the P2P market, but really stressed this weakness concerning the source of funding. And I just want to say that regardless of sort of the shock that they have experienced, it is absolutely the case that the platforms that manage to survive these developments now would just become more resilient for it, and they would learn from it, and absolutely would be an opportunity for them to distinguish from the competition and also gain market share. So it is a very good example of the weakness associated with the business model, but also sort of the alternative ways that P2P platforms find in order to overcome this. Now, another very important sort of disadvantage or risk associated with the P2P systems is that investors cannot really rely on deposit insurance in majority of the cases. So, of course, there are many different business models in the P2P lending domain. However, in majority of the cases, it is really not clear how investors are actually protected in the event of failure of the platform. And of course, there is the issue of sort of the ability of P2P platforms to actually deal with asymmetric information as efficiently as banks. So of course, they don't possess as much information, which means that they would be less efficient in actually discriminating between the different risk classes as efficiently as banks do. And this, of course, can lead to bad debt accumulation. But probably one of the most relevant, let's say, concern in the context of the P2P business model represents the difference in risk ownership. So in the traditional financial intermediation, the institution that provides the credit score is the same institution that takes on the risk, which means that it's in the bank's best incentive to actually have as accurate scoring as possible, because at the end of that process, it is the bank that takes on the risk. Now, in the context of the P2P platform, even though the score is provided by the platform, the risk is fully borne by the lender. Hence, there might be an incentive to maximize volumes, even at the expense of credit standards. And this is really one key concern for regulators. We have also seen within our project as well.
And here, Branka, to connect with these risks that you have mentioned, you've worked in several use cases in FinTech Horizon 2020 project. And in one of your use cases, you argued that network models can be used to address some of the risks, some of the main risks emerging from this peer-to-peer lending platforms. Could you elaborate a little bit on this?
Yeah, so absolutely. We have worked on a couple of use cases that really focus around this sort of main concerns that I have just outlined. So I mentioned that the P2P platforms in majority of the business models are actually incentivized to push volumes even at the expense of credit standards. And when we combine this with the fact that they also possess less information about the clients itself, this can really mean that they have quite a bit of difficulty to actually having very accurate scorings. So even if we take sort of these concerns to the side, P2P platforms still can offer a new approach to credit risk estimation because they can strongly leverage on some of the competitive advantages that they have, which is their ability to collect alternative information and their flexibility to use innovative methodologies. And within these use cases that we have basically looked at for our current project, is that we try to understand whether we can exploit topological information embedded into similarity networks generated by the P2P participants. So to account for the interconnections that emerge between them and use this to actually improve the predictive performance of credit scoring models. So this was our main objective. And the two things that we wanted to sort of test is first, we wanted to test whether the ratings that are assigned by P2P platforms are actually a good indicator of default. And then we wanted to test whether the inclusion of this network information or information on how borrowers are actually connected with each other on these platforms can actually help us improve the predictive accuracy of the credit scorings. And the results from our, both of the papers that we have worked on in this domain do suggest, so we find conclusive evidence that the inclusion of such topological variables describing not only sort of the centrality of certain institutions in the similarity networks, but also the community structure really do increase the predictive performance of models used for credit scoring. And we also do believe that we have also identified an approach for sort of improving the predictive accuracies that are also practical. So what I mean by this is that oftentimes there is really a trade-off between model complexity and usability. So right, most financial intermediaries would not be willing to fundamentally change their approach or IT settings for slight improvements in predictive power. So with these two use cases, we basically aimed to present and develop and present a methodology that are founded in the traditional approaches already in place, but at the same time can improve the predictive utility of these models. And this is what we aim to do with both of the use cases included in this project.
And from what I know, you've recently extended the work by also looking at explainable AI methods. So can you give us a little bit more details about what's the importance of explainable AI scoring models and how can this be achieved in practice?
Yeah, absolutely. So this is really a key topic for our team here at ZHavi, and we're looking at sort of this topic in quite a bit of detail. So, right, we mentioned that AI really has developed in this wide-ranging tool that, in essence, makes us rethink how data is actually integrated, analyzed, and used. Now, the use cases that we just now discussed, so these two papers that are also under this project, do provide evidence that AI-based solutions can really provide a new approach to credit risk management. And we have seen also other papers that actually show exactly the same thing. But then when we look in practice, we are noticing that financial service providers are actually still behind the curve in properly adopting AI, so in a comprehensive sort of manner in their processes. And what we have actually found also through our current project, and what is sort of the understanding of majority of the researchers in the literature, is that one highly relevant barrier for a wide adoption of AI in the financial sector is related with this concept of explainability. So AI solutions are often referred to as black boxes because typically it is quite difficult to trace the step the algorithms took to arrive at a certain decision. So even if one has the full list of input features, black box predictions can be very complicated functions of the variables that it makes it very difficult for us to understand how these variables are jointly related in order to sort of arrive at a certain prediction. So at this point, the question is, if the model predicts well, do we really care about explainability? So in practice, absolutely yes, right? For us, it's really essential to verify that for a given task, the high measured accuracy is actually the result of a proper problem representation. And because the model has learned to capture the true dependencies and associations between these variables. So really, techniques have to be explainable so that we can really feel confident in using them and applying them in sort of practice. Now, we have also noticed throughout our interactions with regulators from all over Europe that these concerns are also the concerns of the regulatory bodies. So, right, we have seen that under the European Union's GDPR, businesses using personal data for automated processing must be able to explain how the system has made its decision. So under the GDPR, each user that has been subjected to an automated decision that is now concerning him or her has the right to ask for an explanation as to how this decision was made. And furthermore, we have also absolutely witnessed many regulators are now publishing white papers that are stating explicitly this, that there will be no black box excuses, and that financial service providers that rely on AI-based solutions have to ensure that decisions can be explained to third parties. So of course, the need of explainability, it's really, I feel, fundamental to the process of actually ensuring wider adoption of AI in finance. And within our team here at ZHavi, we are absolutely looking at this through a variety of research and innovation projects. Just to mention very briefly something that we're currently working on. We are currently working on an innovation project that will aim to build a visual analytics tool that will be specifically designed for the credit risk context and will enable both model developers as well as model evaluators, so both a technical and a non-technical audience, to gain some insight into how machine learning applied to credit risk actually works, and to identify the reasons behind certain decisions taken. Now, our idea is to actually communicate these inner workings of machine learning by enabling users of this app to actually observe how specific changes in input would impact the model's output. And of course, the key challenge here is sort of defining the parameters of what we consider a stable model. And by running this experiment, we can then provide really a non-technical audience, users that have no idea about machine learning, how certain models have worked and which features were actually crucial to the decisions obtained. So it is in conclusion, it is really not just my personal view, but also the view within the literature that explainability would become absolutely a key topic in any applied AI research.
Thank you, Branka, very much for this interesting talk. Thank you for all the details and for the details about your future work there. And I'm definitely confident that we can probably record one more video when you'll have more details about the model, the tool that you will be constructing for stakeholders to understand more of these models. So actually to make them explainable.
Exactly. It would be a pleasure. Thank you a lot, Vasile. I quite enjoyed it, and thank you for the questions.
Okay, thank you. Bye.
Bye.